Good morning, everyone. Welcome to the Genghis Weekly Investor Briefing. My name is Damaris Mukulu, and I'm the Marketing Manager at Genghis Capital. We're glad that you could join us this morning, and we'll be reviewing the equities, fixed income, and global financial markets. So we're glad you were able to join us today. Taking us through the different sections will be Chachi Logutu, who's the Head of Research at Genghis Capital. Our other colleagues, Kevin Ngige, who's an equities trader at Genghis Capital, will also be joining us to talk about the different stocks in the local markets. And then a bit later on, Mathew Kabeere of FX Pesa, EGM Securities, will be joining us to give us an overview of the global financial markets. If you have any questions related to any of these different sectors, please feel free to send a question using the Q&A tab, and our panel of experts will tackle it at the end of the session. I believe we are ready to begin. Churchill, over to you.
Thank you, Damaris. Good morning to everyone who's joined us this morning. Let me share my screen. Okay, so I'll walk you through the macroeconomic bits and also the fixed income. And then as I call upon my colleague Kevin to walk you through the equities bits. So starting with the macroeconomic review for last week, the Budget and Appropriation Committee tabled its report on recommendation of the supplementary budget for the current financial year, that's fiscal year 2020 to 2021. Overall, we are seeing that the Budget and Appropriation Committee had recommended an increase of 80.7 billion, but because of an amendment that was introduced in the floor of the House, that edged up to 84 billion thereabouts. But that said, we are looking at the initial budget, supplementary budget estimates, that's from the National Treasury, had an increase of 75.1 billion. So there's an increase to the tune of 8 billion that was from what was initially introduced by National Treasury and where we are right now. But that's it. So that's taking the current budget to the national government to 1.972 trillion based on the supplementary adjustments that we've seen. We are expecting to see the supplementary appropriation bill to be introduced sometime this week. And of course, it will be competing with some of the other bills that will be debated. And the major one is now the Constitutional Amendment Bill, popularly known as the BPI, which expect to be introduced and to be debated upon once Parliament resumes comes back from its short-term recess. That will be tomorrow. So that's what we're expecting in the course of this week from a macro perspective. The other thing that we saw last week is the money supply data as at January 2021 that was published by the CBK. And one of the things that is contained in that data is the private sector credit growth. So as at the month of January, that spiked up to 9.3%. So the graph that you're seeing right now is the private sector credit growth from October 2019. So this is a month before the complete reversal of the interest rate cap, which was, there was the ceiling that was still there, and it was completely removed at the start of November 2019. So just trying to see what has really happened in between. And of course, last year we had the COVID-19 shock, so that slowed down the private sector credit growth, or what banks could have that appetite to be able to lend to the risky segment of the creditors. But that said, so just looking at between April last year up until right now, we are seeing that the aggregate stock of private sector credit has grown by 180 billion thereabout. And of course, if you compare to what the banks have lent out to the government in terms of government securities, is quite higher than that. So it's just telling us that there's that cautiousness between banks to lend to the private sector, but now lending to the perceived less riskier the government through the bonds or the T-bills that are being issued on a frequent basis. The other data that came out in the weekly statistic from CBK is now that the diaspora remittance edged up to $260 million. So we're looking at 27 billion shillings thereabouts last month. And that was an increase of around 19% from the levels that were seen a year ago. So that's really been quite positive news coming from diaspora remittance, so to speak. So getting on to calendar is still light this week, unless any of the developments that might likely play out in the National Assembly, but nonetheless, we're still seeing a light week ahead. I will still expect that unemployment rate report for fourth quarter for last year to be published. It's been long overdue. So that's the one thing that we're keeping an eye on in terms of our macroeconomic calendar. So getting on to the fixed income, last week, we saw the second consecutive week whereby there's a 23% dip in the weekly activity. So last week, the overall turnover was 10.9 billion, and most of the trades were on the infrastructure bonds and also the reopened March 20-year paper. So that's the FXD2 2018-20. So those were where most of the activities were heavy on. And looking at the T-bills segment, we saw that last week reversed what we saw the previous week, where the previous week there was a dip in terms of performance. But last week we saw that the performance rate, basically comparing the bids that were received as compared to the amount that CBK was looking at. So CBK was seeking to pick 24 billion in the weekly auction, as it usually does, but it picked it received bids of 27.6 billion. So that represents a performance rate of 115%. And with yields edging up close to 0.5% on from the start of this year, and comparing with the lows that were hit last year, we are seeing that yields have gone up by an approximate 1.45% from the lows that were hit in July. Speaking of which, so I'll take some time, and this is a spillover question that was raised last week that we are not able to handle comprehensively, and that's on the yield curve, or how have rates gone up. So rather than just looking at the yield curve on the T-bill segment, so I've just pulled the yield curve for all the tenors. Right now we have maturities from 91-day T-bill up until 23-year bonds. So on the left part, it's just telling us where the yield curve. So yield curve is the representation of, so for instance, all the bonds, all the T-bills, their yields, and then you compare with what was there last year, same time. So that's what's been represented on the left part of the chart, so the yield curve. So we are seeing that on average, we are seeing that the yield curve declined 0.18% on a yearly basis from last week's close compared to last year's around the same time. So we're seeing that it's on average, it has declined negative 0.18%. Of course, you see that mainly between the 2-year up until 6-year, there's that decline, which is quite significant, and also between 18 years up to 23 years. So that's where it's been quite significant. So if you look at the start of this financial year and up until right now, we are seeing that on average, the yields have gone up 0.28%, or in more technical jargon, 28 basis points, so 0.28%. So that's what's been represented on the chart on the right. So in layman's term, looking at what's there on the right, because there's an inverse relation between the yield and the bond price. So on average, you are saying that with the yield going up an average of 0.28%, is telling us that the bond prices or your portfolio, assuming that you are having a portfolio of all the bonds that are there, it has gone down because of the inverse relationship. When yields go up, the bond prices go down. So that it's playing out, and that is a real concern. And look at the start of this year across the whole spectrum of the yield curve from the 91-day table up until 23-year bond, we are seeing that there's an increase of 0.26% increase in the yield curve between the start of the year up until right now. And that tells us that even the bond prices have gone down. We are seeing that that is quite significant between the 91-day T-bill up until 14-year. That's where we've seen that there's been an commensurate increase in the yields at that point. So anyone who is holding a bond this time compared to at the start of the year, on a price comparison, it's telling us that the bond prices have gone down. But of course, we are seeing that it's also supplemented by the coupon payments that an investor is getting. So that somehow nets it off. But on a yield curve basis, we are seeing that on average, an investor has lost because of the yield going up. And there's that inverse relationship between the yield and the bond prices. So that is a concern, a genuine concern, but nonetheless, there's that income that an investor is expected to pick from the bonds. So moving on to the review in terms of the liquidity trends last week, the interbank rate on average went up by 0.4% last week to 5.4% on average. We saw that the open market operations, or in short is the OMO, was quite mixed last week. That's where the CBK comes in to assess at any given day what's the liquidity situation. And on Monday session, they assessed that liquidity was quite low in the banking sector, so they had to inject liquidity. They were seeking to inject 15 billion. They received bids worth 15.1 billion, which was at a rate of 7.8%. But then between Wednesday up until Friday, they sought to mop excess liquidity to the tune of 25 billion in those 3 days. They managed to mop 19.5 billion at an average rate of 6.0%. So then again, we are seeing that in the later part of the week, it's signaling that there was excess liquidity. But then on the other hand, if you compare with the interbank rates, we are seeing that liquidity rate, or rather the interbank rate, went up by 0.4%, which is telling us that there was some tightness in liquidity. So these two are giving us mixed signals in terms of the liquidity trends in the market. Looking at the net domestic borrowing, right now we are 357 billion, which represents 66% of the domestic borrowing target in the financial year, which is at 540 billion. Moving on to the week's trades, we are still looking at FXD2 2018-20. We're still seeing attractive entry levels between 13.2% to 13.3%. And that's an investor could come in at par, whereby if you have 100,000, hypothetically, you'll have to invest 100,000, but of course, 1,000 for every 100,000, at least to cater for the accrued interest component for that. But we're seeing that it's quite attractive because it's more or less at par, and it has a relatively higher coupon rate of 13.2%, withholding tax on that paper is 10%. So you are seeing that it's quite attractive from an income perspective. So I'm not quite sure whether Kevin is on the call, so that we can.
Kevin is on.
Okay. So let me stop there and then invite Kevin to walk us through the equity segment.
Thank you very much. Thank you very much, Churchill. I think I'll just share my screen real quick. All right, thank you very much, and good morning to everyone who's joined us. So on the equities market, there wasn't much movement last week. I think all eyes were eyeing the results announcements and also the fixed income space. So we saw a slight increase in the all share by 3% to 166.94, and a marginal increase in the NSE 20, that's the blue chip index of 0.5 to 1,933.6. Turnover declined 37% to 2 billion over the week. Top gainers were Jubilee, Captura, and Cooperative. Of course, Cooperative because the numbers were out. Top losers, as usual, Uchumi, Liberty, and Total, but on marginal volume. So foreign activity averaged at around 48% on both foreign and foreign participation on both buy and sells. Accumulation or buying was mostly on EABL, Equity, and Safaricom, while we saw exits on KCB Group and Stanbic. Of traded stocks, of course, was Safaricom, which accounts for 57% of all traded shares in the NSE, EABL, KCB, Equity, and Stanbic. So we saw a couple of results announcement. I think we saw numbers, KCB numbers, we saw Cooperative numbers. And some interest was spiked. As you can see, Kenya was third on our basket of regional peers by having a year-to-date increase of 9.75%. I think we're just behind Ghana and Nigeria, who are at 12 and 10% respectively. So the corporate calendar, as you can see, we had COP announcing a 1 shilling final dividend. Books closure is 31st March. We had BAT at 41.5 shilling final dividend. Books closure is 16th of March. Of course, we have KCB Group announced last week, 1 shilling dividend. Book closure is 26th of March. We have Kengen at 30 cents final dividend. Books closure is 29. We have Stanbic Holdings at 3 and 80 cents dividend. Books closure is 21st. And finally, we had Kakuzi, who announced an 18 shilling final dividend, and the books closure is 31st of March. Our long-term equities traded years for the week. We have a buy on Cooperative Bank, as I mentioned. It released the numbers last week, giving a 1 shilling final dividend. That's around 7.2% dividend yield compared to its price at around 13.20. Of course, this is better than its peers on both when you talk about the dividend yield, that's 7.2%, which is better than the industry's average of 5.2%. It's cheaper in terms of price to book at 0.96 times, so marginally, versus an industry average of 0.97%, and the return on equity of 13.7%, of course, gradually higher than the industry average of 11.8%. We expect to see more announcement today. I'm not sure if today, maybe the rest of the week. I'm not sure if Churchill had mentioned. We still have Equity Bank to go, and a couple of few other banks. That's it for me.
Thank you, Kevin, for that presentation. Mathew, over to you for the global financial markets.
All right. I need to share the screen, please. Damaris?
You should be able to. Go ahead. I've enabled it for all participants and panelists.
I think he's still sharing. Kevin is still sharing. Please stop sharing, Kevin, so that I can proceed.
Is it okay now?
Oh, yeah, it's good. Thank you. Good morning, everyone, and welcome to this session today. So let's have a look at the global markets. Last week, we had major announcements set up for the big banks. That's the Federal Reserve, the Bank of England, and Bank of Japan. And of course, we're speaking about the interest rates and the outlook on the economic growth. So what happened? The Fed decided to leave their interest rate unchanged at 0%, between 0 to 0.25, with a possibility of holding the rates all the way up to 2023. Maybe in addition to that, they really optimistic on the growth of the economy, looking forward to a little bit higher growth rate of up to 6.5. So plus there, oil slumps to 1 month lows due to fears of less demand, of course, coming because of the lockdowns, fresh lockdowns in European zone, and low absorption or shortage of let's say the vaccines, and not very high distribution, again trying to change up the uptick or demand of the oil. US stocks hit all-time highs, of course, with the US dollar trends up again, becoming stronger. Then pound was able to ease because of Bank of England maintained their lending rate at 0.1, and of course because of all those effect of on the US dollar getting stronger towards the end, we had the gold again slumping, so little by little trying to climb back, but it's being limited by the yields, which are still rising, right? And the US dollar getting strong still again. Today in the morning, during the Asian trading session, as the US dollar index went lower at the close of the trading last week, but currently when you check on the charts, it's really high, and that is really keeping a pressure on gold. We look at gold later in the charts. So looking at the week ahead, of course, the main events we're looking up to, we have quite a busy calendar this week, and we have the PMI data, that is the flash PMI data. That is the data which precedes the core PMI. So it's just like 89% to 90% of the actual PMI data which comes up. And it's very important. It's coming up for the Eurozone, UK, US, Japan, and Australia. So it's cutting across the markets. And that's why we want to put our eyes to get insights on where the economic outlook is going to be as economies are struggling to rise up on their feet, of course. And of course, most other important information, important events we're looking up is official durable goods order data. Of course, want to know the consumer confidence, the consumer expenditure, personal consumer expenditure for the US. Again, very important to see whether people are getting are consuming more, because it's very important for the growth of the economy. Those are the indicators that really show that a little bit the economy is rising up on its feet, and people are at least getting up some money as jobs are getting back on, and economy trying to stabilize a little bit. So personal consumption expenditure is very important. And then the US final Q4 or fourth quarter GDP, looking at the durable and capital goods orders, weekly initial jobless claims, consumer sentiment, all that you find it in the economic calendar. And just to maybe point more towards the PMIs, the flash PMIs, check out on Wednesday, Euro area, UK, US, there, durable goods was very important. All these are high impact events that are likely to influence the movement of the currencies. Maybe we have questions about these announcements from the ECB, BOE, and the Bank of Canada. Well, we already know what has happened previously, and Fed's not looking forward to have any change currently on their interest rate outlook, right? So what we're looking forward to at least give more influence is on the PMIs, flash PMIs, right? Durable goods, as we're trying to look up to, and PCE, okay, and the GDP, just to give us try to direct us towards where the economy might be going next. So the products to watch this week, we have the US oil, and last week was quite a big slump, of course, as the US dollar strengthened. I mentioned that, and the coronavirus spread across the Europe once again because of these variants that are coming up. And of course, there are struggles with the vaccine. Of course, we have some issues with AstraZeneca there. And of course, we had the US crude oil inventories rising. That one means there's low demand. And that's what led to that, that fall of the oil prices all the way to test the levels of 58, currently trading around the 61. And we are looking to see whether it will maintain that support level at 60. Okay, currently trading below the moving averages, but it maintains that 60, above the 60 levels. Then of course, looking forward to see whether it will break above the 62 and maybe move above the moving averages. That could be a signal of the move upwards. But again, remember, oil mostly will be dependent on the demand. If the demand increases, of course, that one directs us towards economic growth. Economies, the demand increasing, of course, as looking forward if maybe the coronavirus eases and maybe improvement of the vaccine distribution and reduction or overcoming of this variant. That's what's going to really raise the oil demand, because of course the cuts were maintained all the way to April. Because again, if they will be speaking about the production in the future, we don't know when that is coming up. If it comes up, so I think that could be pushing the oil upwards. But currently, it maintains above the 60 level, right? We might see an upside, but most likely want to see whether it will break above the 62. But if not able and breaking below that 60 level and downwards and below the 58, might see the oil slumping even lower. Moving forward, again, let's look at gold. And remember, gold is used as a hedge for inflation, especially at a time when we're expecting inflation in the US dollar, because of course the Fed chair, they're not really worried about the inflation. Actually, they revised it upwards. They're looking forward to see whether, as the economy is trying to rise on its feet, whether they can allow it. Actually, they allow it. It can go all the way. It can allow the inflation all the way to 2%. And that one gets us back to the earlier on speculations that gold might be on its way to higher levels. But again, remember, this is being cut down or being limited by the rising bond yields and the strengthening US dollar. So on the technical level, as you can see that it's on a short term, like on an uptrend. You can see there very strong support levels around 1700 levels and 1720, currently hovering around 1740s, and trading above the moving average. It seems it's little by little following that uptrend. But what we want to keep our eyes on is whether it will breach the 1755 levels, so the highs of last week, because a breach beyond that level means the buyers might get some opportunities to get in there, of course, targeting some levels of 1770s. That would be that's why you might find the resistance in the future. But if the strengthening dollar continues and the rising bond yields continues, then we're likely to see the gold going even lower, and maybe even breaks that uptrend and tests below the 1720 levels. Then we might want to again check out for opportunities all the way to the 1700 levels. That is for gold. And looking again, going forward to the stocks, remember, earnings report really very important. We want to look at them, and when they come up, depending on the results, then likely to point you towards whether going long or going short. Though last week we've been having a slump on the major indices in the US, though they are recovering now, right? Because of course of the improving sentiment on the economic growth. But now the earnings to watch this week: Adobe, EON, Signworld, CureVac, all these are stocks that you'll find on our platform. Check out and you can monitor how the earnings come up. And based on the dividends announcements, talking about British American Tobacco, NatWest, Itau, all those ones, make sure you watch over those and see whether you can get an opportunity. And that's my bit for today. Over to you, Damaris.
Thank you, Matthew. That was very insightful. And I think in terms of going to the Q&A, I'd just like to continue with you, Matthew, because we have a question from Wallace Mburu. I know you touched on gold and its performance, and but Wallace wanted to know maybe just a concise answer, gold performance and any projections you may have.
Okay, about gold, of course, we're looking up to see. Remember, gold is one, it is priced in terms of the US dollar. Of course, we have others like euro, Turkish lira, but specifically on the US dollar, remember, gold is a hedge of inflation. So whenever we have inflation setting in, and we have, of course, it means the dollar is weakening, and then people are finding gold a little bit cheaper, or traders are finding gold cheaper to go and buy. So currently, we are at a time when the US has already approved a 1.9 trillion stimulus. That one is a yes for likelihood of increasing stimulus. And last week's Fed meeting, again, is a confirmation that the Fed are not concerned, are not really worried about the increasing inflation. So my opinion is that gold is still on a buy or an uptrend, though currently we're seeing a pullback a little bit. That's when it's because of the pressure by the increasing dollar index. So again, we are going to keep watching on those technical levels, because again, we have to make sure that our decision in trading is just based on the breach or obedience of those technical levels. So currently, gold, as we speak, is at 1729. The chart that I showed you earlier on, I had captured them earlier. So as the market opened, we, of course, and the US dollar index is still high from the previous week, last week's lows. So at 1730, it's already testing the 50 moving average, trading below the 100 moving average. We're waiting to see whether it breaks below that trend line, and a breach of the 1720 support level is going to direct us towards our short positions, maybe all the way towards 1700s. So that's the outlook. But if it bounces above that level and maybe is able to breach, again, keep above the moving averages and breach the 1750s levels, then we might be up for a bullish move. But actually, we have to keep those technical levels at watch. On the RSI, again, we see it's trying to breach the 50 levels on the 4 hours, right? And if that only coincides with the break of that trend, then we might be looking up to some bearish or short positions down, but be sure towards the technical levels.
All right, then. Thank you so much, Matthew. A second question for you from Peter Irungu. He wanted to know what your opinion on EGM securities is in terms of giving support to or giving opportunities for investors to participate on Bitcoin. And he also wants you to consider perhaps including the Bitcoin analysis on your weekly review. So what's your response?
Good question there. Well, we will really be very happy to offer as many products as possible. Of course, that one is again is on the management, but currently we don't have Bitcoin, okay? Because of course there are regulation issues, but we don't know the direction that the CBK might be taking, or the government. If they allow it to be offered on our platforms, then of course we are more than willing to offer as much opportunity as possible. And on the insights about Bitcoin, of course, I could be speaking a little bit about Bitcoins and maybe give them more insights to see where it's moving. But about it being offered, it's something that we might be looking up into the future if it gets allowed, because again, it's all about the regulation, and that's what we can give for now.
Okay. All right. Thank you so much, Matthew. Let's move to equities. And Kevin, thanks for handling a lot of these questions in the chat, but I'd just like for us to read and discuss for the attendees who perhaps have not been able to go to the Q&A and read the responses. So we had Jedediah Kaseva asking, the price of COP shares went up and then down. What is the meaning? Is it a good time to buy shares when the institution announces their financials for the year? So Kevin, I know you responded. Perhaps you could discuss for all attendees.
Oh, okay. So basically, to answer Daka Seva, prices are as a consequence of a couple of things. So there could be speculation, there could be new buyers, there could be buyers who are accumulating because of the news. There's just a general reaction towards the results announcement. And as I answered Jedida, is the price reaction are as a result, again, of various things, including what I've mentioned. We just saw Co-op issued a 1 shilling dividend. So just to mention, that's around 7.2 dividend yield. Also, just looking at Co-op historically, it's been sort of a stable counter. The only disadvantage to Co-op is that it has an insignificant foreign holding. So it's mostly a local play share. So, but if you're looking at it in terms of return, we just looked earlier, return on investment. It's Churchill has something to say. Churchill.
Just continue.
Okay, so we saw it's in terms of return on equity and price to book, it beats the industry's average. So that's the banks that we have listed under the Nairobi Securities Exchange. So to us, I think we had Co-op as recommended as a buy, and that's why you saw the drastic price reaction. Churchill.
Thanks, Kevin, for that. And just to mention another piece of corporate announcement from Co-op early this year was that they had put out a profit warning, which basically implies that its earnings will be lower than 25% in the last financial years. But what you saw was 24.5% dip. So it was just within it wasn't greater than 25% dip. So that's my point. So I still see that we could see some excitement, majorly based on the dividends payment, 1 shilling. It has it's totaling to around 5.8 billion total payment to each shareholders. Significant chunk of that is now the cooperatives, which I think holds around 54% of cooperative shares. So that will be a major headwind for that portion of its shareholders. So yeah, that's what I wanted to add. Back to you, Damaris.
Okay, thank you. While we're still talking about equities, we had Ken Mogena in the chat ask about Kakuzi. So he wants to know the outlook for the counter, how many shares are currently floating, and whether we have a recommendation on it to buy or hold.
Maybe I can attempt on, I think Kakuzi, as with most agricultural stocks, are stocks that are tightly held by the owners. So we tend to have a very low free float percentage, and at bet it's nothing more than 25 to 35%. As such, the share becomes quite illiquid. We don't see much activity on them. I don't think it has any or very few, if any, foreign holding. Chacha, I don't know if you have anything to add on Kakuzi.
For Kakuzi specifically, we are saying that it has in terms of shareholders, it has a significant foreign share ownership. I think to the extent of 48% amongst 2 big shareholders. And then the single largest individual shareholder, that's Dr. John Kimani, has around 32% of shareholding. And over the last couple of years, we've seen that this significant individual shareholder wanting to have a controlling stake in Kakuzi. Just looking at his story has been out in the media flow in terms of where he started out as a squatter in that plantation, and then he's one of those rags to riches stories that you've seen in the local industry, and particularly concerning Kakuzi plantation. So in terms of the shareholders, I think the significant chunk is foreign participation, 48%, and then 32%. Of course, there's been some boardroom wrangles because at 32%, one would have a bigger say in the operations of the company, but that has not been granted to him, from where I sit at. So the overall shares is around 17.6 million, and I believe that entirely it's a free float. So if you exclude the 48% that predominantly is within the foreign stake, and then this 32% from the single largest shareholder, so we're looking at around something 20% that is freely traded at any given point. And that also speaks to the illiquidity that Kevin talked about in this counter. And looking at the prospects for Kakuzi, it released its full year 2020 results last week. And one of the things that caught our eyes was that dividend announcement, 18 shillings per share from 14 shillings per share in the previous financial year. So that's quite something that will excite the shareholders of Kakuzi. The prospects of the company, well, it's quite diversified. It's into macadamia nuts, it's into avocado, and I think it's into wood products. Over and above the other agriculture products that it does, but those three products are what stands out. Last year, it was impacted by the negative prices, the macadamia nuts and avocado. So the outlook majorly will be on the prospects of a recovery in the prices of these two key products for Kakuzi. So to me, it just boils down to that. And of course, last year, I think there was that issues about human rights on Kakuzi plantation. It has not been fully ironed out, but Kakuzi management, or was it the board, which came out strongly saying that it will like to iron out those issues. So those other things which may not be related one-to-one to the financials, but it's giving some positive sentiment or positive story to the counter. So those are some of the things that stand out for me in terms of the counter. But that said, we don't really actively cover it as much, but those are my sentiments at this point in time.
Thank you, Churchill and Kevin. Ken is very appreciative of your insights, and Ken, we're looking forward to you to start investing. Well, Churchill, you mentioned the word excite, and I suppose we could delve into Kamal's question, who doesn't perceive the NSE as having very exciting options for the market? I know Kevin gave his 2 cents, which I strongly agree with, that there's still opportunities, and we are in the top 3 exchanges in our peers. So that's awesome. But maybe someone could talk more about that. That's Kamal. What are the prospects of investing in NSE? It rarely excites the market. Secondly, he says that Stanbic plans to buy back its shares from the open market, similarly to NMG, but it hasn't created the same buzz as it did when NMG announced. Why is that the case? Over to you guys.
Let me tackle, I think Kamal's question was talking about NSE, the company, not NSE, the exchange.
Okay. Well, that puts a different dimension to it.
Yeah, I know Kevin now talked about generally, but the question was now in regards to the company itself. Ideally, it relies on trading commissions and the other kind of revenue streams that it relies on, but predominantly the trading commissions that the intermediaries, Genghis being one of them, that also generates generates. So there's a portion that now goes to the NSE, and it cuts across all the intermediaries, be it investment bank, be it stock brokerage. And of course, there are other kind of products that NSE has been trying to bring on board so that it can be able to diversify its revenue. But ultimately, it boils down to the volumes, trading volumes, be it on the equities and also on the bond, partly to the bonds to an extent. That's where it relies its revenue on. I may just stop at that point because I don't have much visibility on the counter itself, but I'll be able to dig much more information. Talking about Stanbic and the difference between that buyback between Stanbic Bank and also the NMG, it boils down to the fact that the Stanbic's share buyback was from the parent buying back shares on the local entity. So that's the main thing that you are seeing. And it had already had a price. So here we are looking at transaction had already been arranged whereby the parent will buy back, I think it was 10% of the shares on its local entity. So that somehow something which is already, you have a buyer on one side, you have a seller on the other side. So that's, you don't involve the other shareholders. So that wasn't exciting the markets. But on the other hand, we have NMG coming up, I think it was 26th of February, coming out and saying that it's planning a share buyback up to 10%. We still don't have the details around that, but intuitively, it's something like it's getting the shares from the market. It's an open market. It didn't speak to the where this buyback will come from. Is it buying from its own pool of an institutional shareholder or one of the biggest shareholder? That's still not yet clear, but it's more likely that it will get that 10% from the market. It has, I think, 182 million shares that are outstanding. So 10% of that is 18 million shares, which will be transacted. We still don't have the nitty-gritties at what price will this share buyback be conducted at, those kind of details, or where will the monies come from? Will it come from the profit, the net income from the company, or will it come from some NMG now issuing some new shares? So those details is still not yet clear. But what comes out is that because the management is trying to buy back shares, it has a positive signaling effect. Because if you look at NMG shares, I think it's been on a gradual decline, on a 52-week high of, I think, 71 shillings. By the time this share buyback details was being announced, highs of 13 shillings per share. So it's just seeing that gradual decline. So of course, there was that excitement because for every 10%, if you remove 10% of the shares, so this is 18 million of that, it means that the existing shareholders will have a 10% increase, ownerships, increased stake in NMG. So that's where the excitement has come about. And in as much as we still don't have much visibility around it. So that explains the difference between NMG and Stanbic. I don't know whether Kevin has other insights around that, but let me
Thanks, Churchill. I think you've covered pretty much about NMG. I have personal issues with NMG myself, and mostly it's to do with their costs to income and their CIR ratio. They went digital. We saw that on, I think, both PD and Daily Nation. And I remember working out a back of the envelope calculation in terms of, say they got 10,000 subscribers, how much would it be for them? It was only coming to around 32 million shillings. I mean, that I don't think would even cover the printing cost of their digital. So I think generally the media industry in Kenya is really disproportionate in terms of the one who takes the top has left the rest by a margin. And I think Nation Media Group as its standard are both just trying to play catch up. So that has, and I've spoken to some of the guys in that industry, and they say it's still tough, quite tough for them. So yes, the company buying back shares is a signal of their confidence in the company. But the question is, yes, the buying back shares will come and go, and the ownership and the shareholders will have 10% more. But what else? What's the plan? What's the structure going forward to ensure sustainability, to ensure consistent cash flows? And I think that's where I really struggle to see where NMG is headed. So to me, it would still be, if I was going to buy it, would be a very speculative buy. Thanks, Damaris.
Thank you, gentlemen. I think we can move to fixed income. There are several questions related to different bonds. So let me just ask you two quick ones. Excuse me. Wanja Morage wanted to know, why is it a concern that bond prices have gone down? Isn't this a factor of demand and supply? And then there was a second question from Kevin Kakuti. With regards to FXD 2018-20, is there a disadvantage of joining now? And if one opts to exit before maturity, the 20 years, is there a loss? You can use a hypothetical figure. Okay, I don't think let's use the figure. Let's just talk about buying a bond after its issuance. Churchill?
Thanks, Damaris, for those two sets of questions. So the first one is about whether it's a bad thing. Let me just look at it.
Whether price is going down is a bad thing for investors.
Oh, yes. And then the supply and demand factors. Well, there are a number of factors that dictate the yield curve, because the yield of a particular bond. And yes, as correctly mentioned, could be a factor between supply and demand, which dictates that. And that's granted, whereby in the case that if, for instance, say for argument's sake, we are looking at the FXD2 2018-20, and the demand is not there, so it could now speak to interest rates going up. But that said, there's some cross currents to it, to the impact about the demand and supply factors. One of them that plays out locally is bids a bond that is being brought in the market, and the average bids comes to say 10%, but then CBK rejects some other bonds which had aggressive bids or had aggressive yields. So that means that that market weighted average will now go down to say 9.7% hypothetically. So that may not necessarily speak to the demand and supply factors. It may speak to the comfort level that CBK is looking at, or what it deems as acceptable at any bond that comes in the market. But outside this, and what primarily the question speaks about is the impact, or the impact about the bond price if the yield goes up, and the negative impact about that. So that's the core of the question. And ultimately, if you look at the yield price, if you look at the yield of a bond and the bond price, and there's an inverse relationship between that. So if the yield gradually starts going up, it means that the bond price will now go down. And if you want to exit, and that speaks to the second question, perhaps you enter the bond today, it's giving you a yield of 10%, and say you hypothetically you invested 100,000, and then a month down the line, the yield on that bond is 11%, hypothetically. So that means that you'll be selling it lower than 100,000. So that's where the area of concerns comes about with a rising yield. In the event that you want to sell it off, or in the event that you are valuing your portfolio at the start of the month when you invested 100,000, and then you compare at the end of the month, that 100,000 has come down to 99,000, because you have to mark that bond to where the yield exists, and that is a concern for any investor. Of course, even if, and the same also applies the way you look at, say, you invested into Safaricom shares. When you bought it, it was at 24 shillings, and then it goes up to 25 shillings a month later. So your portfolio has gone up by that much, by a shilling. And the same also applies to the fixed income segment. A rising bond yield has a negative impact on the portfolio, and that's where the concern comes about. So if I speak to the second question about FXD2 1820, this bond was reopened this month, and what the average yield was 13.34%. So right now we are looking at the yield has gone down. So it means that you as an investor, if you want to invest right now, you'll invest at a slight premium as compared to if you had gone into the primary. For instance, right now we are looking at 13 point, rather at the auction results, it was at 13.44%. And the price there was for every 100,000, you'll have invested 100,000 plus that accrued interest, because this particular paper paid the last coupon in 25th of January, and it's 13.2%. It pays coupons every 6 months. So it's just that portion since the last coupon payment up until the value date of the bond, which was last week. There was that, I think, 2,000 shillings for every 100,000 that an investor had to pay. So in total, as an investor who came into that bond, you are paying around 100,500 shillings thereabouts. But right now, the yields have gone down slightly. So even in our week's trade, we are looking at between 13.2% to 10.3%. So that means that you'll pay around north of 101,000 as an investor to get into this bond. So a month later, 2 months later, the yields go down. It means if the yields go down to say 12.8%, it means that you may have a probability of selling it higher than this 101,000 that you are entering at this moment. And if in the event that yields go down, in the event that yields go up, say to 13.5%, you will sell it at a lower price than you entered in. So that's the mechanics of the yields and the bond pricing if you want to sell in between. But if you want to ride up until it's maturing in 2038, you'll get back your 100,000, but of course in between you'll have received the 13.2% coupons on a yearly basis. So I hope I've answered Kevin Kakute's question.
You have, very comprehensively. Thank you so much for that. Okay, so we're nearing the top of the hour, so I just want to race through the last pending questions. We have Titus who asked, Kevin and Churchill, I've been observing Centum stock for a while and its share price has been on a decline. The CEO said that its stock is highly undervalued. He stated that the net asset values per share is 75 shillings. Recently, we saw one of its major stakeholders buying a considerable amount of shares in the market. Do you consider Centum stock to be highly discounted given its share price at the moment and the sentiments from its CEO?
Sorry, I'm just trying to look at the multiples of Centum.
Okay. Perhaps as you do that, I could read the second question from Edward. Edward is Equity Bank and NSSF have previously sold their stake in Housing Finance Group, and now Britam have announced that they want to sell part of their stake in Housing Finance Group too. What does this mean about HF Group? Should I also sell my holdings in HF Group, or what's next now? So Edward has concerns about housing finance. Kevin, are you ready to address that?
Yeah, maybe I can touch on Edward before we get on to Titus. So housing finance has traditionally been struggling. We know that the majority owners of housing finance were Equity Group and Britam Insurance. So it was almost a conglomerate of the three companies. Yes, we've seen quite some selling off on HF. I think over the last, if you're looking at it year on year or even over the last 3 years, it has actually been on red. They've changed management several times, but when an anchor shareholder, which is one of the biggest shareholders, like say Equity or Britam, gets out, unless that stake is being taken on by another anchor shareholder, say like the Nordic funds, as we have on Equity Bank or KCB or Safaricom, then it becomes quite challenging to see the way forward for HF. We also know most of their loans are mostly on mortgage and real estate, where we've seen quite some depression over the last 1 year thanks to the pandemic. So to me, HF has always been a cautious stock, and it's mostly a speculative stock. I wouldn't be in it. Churchill?
Thanks, Kevin. With
Centum.
terms of Britam, and let me just talk about Britam, and now that you've talked about it. Okay. In terms of Britam, the last time we've had a number of meetings, virtual meetings with the new CEO, one of the things that he talked about is this asset allocation, whereby we have Britam is an insurance, but yet if you look at its assets, it has invested into equities, that's Equity Bank, and also HF. And of course, over and above, it also has the property development. So you're looking at, so the CEO was quite categorical, unless there's that value that might come investing into these two entities. Of course, they are, because of the legacy reasons, he saw that with time, or he hinted that with time, we could see a gradual reduction in those entities. And that's what you've seen even from the news article that came out in the Business Daily, to the point that Britam will exit its investment into HF Group, and so that it could primarily focus on its core business, and that's in insurance, which I think that's quite, it's brilliant, it's prudent, so that it can be able to stick to what it knows best. So it's something that it's been quite key. It's been quite key about the new CEO, and of course, the blessings from the board, because right now Britam is at the tracks of implementing a 5-year strategy. So who knows that that is part of the core strategy, and it could be in Britam's favor because of the volatilities that come with holding these equity investments. Price of these two counters, one day it's at say 55 shillings for equity HF. I don't know the figures, but then at the end of the year it's at lower price. So that has been the major factor for volatilities in Britam. So if they exit, so at least you can be able to see more stable earnings for Britam in the long term. So back to the question about Centum, yes, the net asset value is based on the CEO's comments, is around north of 75 shillings per share. And even if you look at what we track on the weekly report, what's a metric called the price to book, which is basically a measure of the current price of Centum as a percentage of its net assets. And that's around 0.22%, 0.22, which is roughly 22%. The price of the current price of Centum against its net asset value. So it's just from that perspective, there's a case that the net asset value is quite it's quite high, close or at that 75 shillings per share that the CEO commented about. So from that perspective of the price to book metric, we're saying that the counter have been discounted by the market. Of course, there are so many factors that lead to that negative sentiment on the counter. Centum is primarily investing into some other businesses. We've seen in the last couple of years, it has been somehow dropping the winners, be it Almasi Beverages, amongst other stakes that it has had, but then it has been sticking to some investments, which takes a long time for them to realize returns. And right now, to be sure, I think it has a negative return on equity. So the market has gradually discounted, or rather punished, the Centum's stake. But of course, from a management perspective, is quite volatile, or is not in their interests. And then I think a couple of years back, even before the formalization of this share buyback program, the anchor shareholder, that's Dr. Kirubi, mentioning that he'll gradually buy back the shares in the open market. And to be sure, on a quarterly basis, we've been seeing that ownership stake has been gradually increasing. So to the question, yes, it's been discounted, but because of a number of factors, but those that whole discounting is not something that management would like to see. Hence, it's been quite clear, or been sending signals that the counter has been heavily discounted by the market. So it's all for us to see that whether the anchor shareholder will now come out right now that we have this share buyback program and explicitly say that he'll get, say, I don't know, we've heard from NMG's 10% share buyback. So it's just for the market to see what the anchor shareholder will buy back from the market. So back to you, Damaris.
Thank you so much for that, Churchill. Thank you, Matthew, and thank you, Kevin. I believe we've addressed all the questions that our attendees have raised today. Thank you so much for your comprehensive information that you've shared. To all attendees, the video will be uploaded to the Genghis YouTube channel, so please be sure to subscribe and you'll get an alert. You'll also get your usual weekly email by Wednesday. Asante sana for joining us, and let's meet next week, Monday, for the pre-Easter edition. Have a good week, everyone.